going to start with if it bleeds, it leads, and sovereign debt markets are on the bleeding edge of the news headline. So figured we start there. That's where people's attention is gonna be, and then we'll build up from that. So the legacy sovereign debt markets, like in our mine print hash framework, they represent the print part of those three tools: mining, printing, and hashing to secure a money, right? And more specifically, this legacy monetary system that we're leaving behind, that just solely utilizes and focuses on the print mechanism to defend its monetary system, while just leaving aside the other two. Mining being kind of the ancient technology. We've known about it for a long time, using coinage or gold as base money, silver as base money, and then Bitcoin with the arrival of hashing. But I want to open with a flashback to a slide we showed on our show on May 28th earlier this year, roughly 2 months ago. And this quote came from the European Central Bank's financial stability review document. Um, Really started here. You look at the highlighted part in the red box. There's this open heart surgery underway in global energy markets, that we're talking about, just feeling the elephant in the dark, if you will, with the Venezuela situation, the Iran situation. We'll talk about those, don't worry. But notice what we saw here, the quotes, the acknowledgement that there was an abrupt repricing in sovereign bond markets ahead, and that this would pose risk to euro area financial stability. So they called their shot, telegraphed it, and what we're seeing right now in debt markets, yield curves, et cetera, this was all kind of noted. We saw this coming. So um, as we kind of unpack what's going on, um, note that this does go in narrative context with everything we're seeing in a very volatile year in, I guess, history, underway in 2026. So looking at, this is the world bond markets function in Bloomberg. We see, in the yellow box I highlighted on the range, pretty much all sovereign debt, like every country's sovereign debt, is trading at yields hitting their 52 weeks highs. The U.S. Treasury, Canada, note Mexico's U.S. dollar denominated debt. We'll talk about that in a second. The UK, Eurozone, and then the Southeast Asian economies who are part of this order, like Japan, Australia, New Zealand, and South Korea. That whole group represents what I think of as the entirety of the Western coalition that came out of the post World War II order.
Sure. Yeah.
Um, Quickly, what I want to talk about is the dog not barking, to lift the term from the Sherlock Holmes novels and kind of detective crime scene analysis. Notice which yields are bucking the trend and are not at all involved in this sell off. So, number one is China, whose 10-year yield sits at about 1.7%. That's still reflecting, like, so the Chinese economy, this nascent emergent thing, over the last 40, 50 years, as a parallel structure to that post World War II order that we talked about earlier. Um, its own economic and monetary situation, think about it as a mirror image of the situation facing the Western allied uh, conditions, right? All right. Number two, to call out the dog not barking, is the US dollar debt from South American countries, including Brazil and Argentina. So these yields are still high. Notice Brazil paying in dollar terms 5.75% type of level. Argentina at 8.5%. Those are, like, while high in terms of spreads versus the United States 10-year Treasury rate, dollar denominated, obviously, of oh, sorry, I was looking at the low there. Brazil's US dollar rate is 6.3% nominal is where it's trading, 9% for Argentina. That's in comparison to the baseline of the US 10-year at 4.7. Notice, however, that those two, the South American dollar denominated borrowing in terms of spread, is much lower in terms of its overall range than we're seeing from Mexico at 6.5%, roughly. So, what's going on here? There's a key tell. Look at China and then the Latin American U.S. dollar sovereign borrowing costs. This is a key tell as to what I see as like two competing and emergent financial spheres that increasingly look like they're set on a collision course or will be competing with each other over the potentially the course of the 21st century. Um, Noticed within the Latin American U.S. dollar denominated borrowing group, you've got Brazil and Argentina going one direction, Mexico going the other. That reflects a competition, I believe, for the give and take or the pull in terms of the alignment of each individual country within the Western Hemisphere as far as which block they're going to pull towards. Is it the old offshore dollar or the new emerging, call it the stablecoin-dollar standard? We're very early in that process, in my opinion. Still first inning. We won't even talk about it today. That transition. A lot of people ask, where are we in that process? It's still in the crib.
Very early.
Yeah. Okay. So you can see that abrupt repricing that the ECB talked about coming into being on the chart of the German Bund. This comes, 2 weeks ago, we had that horrible 10-year Bund auction. We talked about it, won't reference it, but there were just not enough bids for the capacity that the German government wanted to raise, but also roll over their existing debt. So the trend line since we exited the ZERP policy era in 2022 has really been just an unbroken up and to the right on the German Bund yield chart. If you look at the U.S. Treasury 10-year, you can kind of see the respite we've taken in 2024, 2025 after that bond market impulse and 20 or like the sell off. One of the top, two or three worst years for U.S. dollar denominated debt markets in 2022. In the nation's 250-year history, you did see like a pause in 2024 and 2025 going into this abrupt repricing that the ECB's financial stability review hinted at. But for Eurozone yields and their key, call it risk-free asset, the German 10-year Bund, you really don't see that much of a consolidation or respite for borrowing costs there. So another, just see the vertical, or the up and to the right trend on yields. Then you see the horizontal line on that 3.2% level. We're just bumping right into that. At this point, it seems like there's really nothing to do to stop this. You've got that financial stability assessment from the technocrats and in the European Union, basically acknowledging, yeah, this is going to happen. To make an analogy, everybody probably saw or at least caught wind of the World Cup final this Sunday,
Yeah.
and Spain versus Argentina. It's kind of like one of those games where you watch the game go along with Spain's defense and possession control. The outcome was really all but inevitable as the match went on, and it was very clear here which side was ultimately bound to prevail. Pretty much the same dynamic you see here on the chart for debt markets, sticking to this, post-war monetary framework here. Yields that the abrupt repricing at this point, there's not much to be done other than sit and bear it, take your beating. All right. So a quick look at sovereign CDS shows that what markets are saying is it's not really a solvency issue or a credit risk issue. Notice the Eurozone sovereign CDS are at the low end of their 52-week range. The U.S. and the Indo-Pacific countries, Japan, Australia, New Zealand, South Korea, excluding South Korea, like U.S. and Japan, Australia, New Zealand, they're kind of at the high end of their range, but in nominal terms, it's really not that high, right? So you've seen yields go up, CDS go up less in lockstep. What this is telling me is markets aren't pricing this as a credit risk issue. The rise in yields equates to markets saying this block of economies is kind of at the edge of its resource boundary kind of frontier. And what we need is higher real rates to pull in capital, increase savings, and ultimately that savings will be translated into investment, to build the physical capital stock that by deploying these savings into fixed capital investment. What does that mean on the ground? All right, I'll give an example here to make this concrete, tie it into the AI build out. We've been talking about DRAM prices. Yeah, Cameron and I can't remember the first month we put this slide in context, but it was, if you go back
Quite a
and look
bit.
at our
Yeah.
history, it was October. Once this line started to break out, we were on this price trend pretty quickly. Um, in hindsight, this breakout in DRAM's prices started during the key events that developed in that month of October. So remember what happened. We got the escalation in tensions between the U.S. and China as the U.S. Treasury negotiated a deal with Argentina to help it defend its peso from attack in the foreign exchange markets in the weeks leading up to its election, which ultimately Javier Milei and his new La Libertad Avanza party prevailed in forming like consolidating power in their own, I guess, congressional body. Um, but that caused a lot of heat in the U.S. China relationships, right? We talked about Brazil, Argentinian U.S. dollar yields. Notice those are coming down as the Latin American countries, South America, the resources in the Western Hemisphere align together and are forming an economic bloc. Well, China had plans for those resources as well. That caused a lot of friction in the U.S. China relationship. And as you remember, there were talks in Geneva to kind of put that tension back under wraps, or lower the simmering in the room. And if you recall what happened, China threatened to withhold access to critical minerals, rare earth supplies. Um, what we got out of the Geneva talks was a 1 year kind of delay in tariffs, all of these economic implementations, just around the competition for resources, regional power spheres butting heads up against each other, et cetera. Um, that just to keep a sense on calendars, because we'll get into the timeline. And this is something we'll talk about. We won't get into every detail, but there are a lot of key kind of bottleneck events in the next 6 months,
Yeah.
that creating pressure, creating a forcing function that on this entire situation we talk about with money, fixed income, resources, AI, geopolitics, all of the above. It's a loaded calendar. But one of the key ones to keep your eye on is that tariff truce that was agreed to after the October tensions, the Argentina election rolls over, all of that. That agreement lapses on November 10th. So, kind of we're living in a world where it's just one pressing urgent deadline after another. Um, that rare minerals resource constraint is an important like factor among multiple factors driving interest rates higher in the post-war economic bloc. How do you know that? Well, the growth in the U.S. economy is heavily dependent on this AI build out. That AI build out requires metals. Like, look at all of the inputs that go into like an AI data center, whether it's GPUs, server racks, concrete, on the ground, etc. It takes a lot of minerals, and it is no coincidence, in my framework, looking back on this, that DRAM pricing, like we start to show the resource constraint in the Western economic order uh, right in October of 2025.
Yeah.
All right, so um, in hindsight, or sorry, not in hindsight, but like in real time here, these last 2 weeks, what we can see that process, like we're consuming all of those resources, we're running into the boundary constraint. Um, we're seeing it now show up in yields for the companies involved in the AI build out. So notably, Oracle being the textbook case. This company has relied heavily on tapping the US dollar public bond markets, not just in the first half of this year, but like multiple years. This is of the um, AI data center build out, involve companies, the hyperscalers, et cetera. Oracle is the one that represents the most heavy kind of dependence or allocation of of capital coming in from debt and credit markets. So what you can see here in the last 2 weeks, it's we talked about sovereign yields rising. You gotten hit from a double whammy, and it's showing up in Oracle notably. Top chart is like nominal yields. This is just one bond, an Oracle 2034. I would go back further in the history of the chart. I got back to 2024 pricing here. For some reason in Bloomberg in the last couple of weeks, the prior data on this is cut off. The furthest I can go now is 2023 or 2024 on bonds. I don't know what that issue represents, but that is a new development that bond traders will probably notice if they're trying to find good data. But yeah, general public like this, yeah, you wouldn't see this on Yahoo Finance.
No, I wish.
You see, all right, this is 2034, which is 8 years away maturity. You can see the yield here up, it's 6.69, 6.7%. That's the market yield on the Oracle bond. And then you can see below this the benchmark U.S. Treasury bond. I got the American flag pointing to it. It's trading at a 4.62. See them both rising, but then on the bottom chart, the difference between those two, that's the Oracle credit spread that the market trades the Oracle's debt at, representing the credit risk of the borrower. You can see that number blowing out to over 200 basis
Widening.
points. Yeah, this is something. This represents like a real development to be aware of. So in my framework, this basically reflects a world where we're running at the limits of our existing resources to create further growth in the economy. Now, to go from here will require increased savings to funnel into and continue on that investment process. New growth from here requires building up the savings in the financial channel of the American economy, or America, like more broadly, America's trade partners in this emergent American order, Pax Silica, all of that. We won't talk about that today, which will then get funneled into fixed investment. So you can see examples of that fixed capital investment for yourself if you're like driving through or flying over Boise. So I was recently here. I just wanted to point this example out. So what's going on is the consumption side of the economy, the higher interest rates are placing an incentive on, say, the household side of the economy to belt tighten with our savings as big projects like this massive fab in Boise work towards their completion. Once we finish this massive project, or there's several of them like these throughout the country, that reduces the like kind of the bottleneck as we push up on that resource constraint. You can see it in like that DRAM prices chart we showed above. But that's really what we're dealing with here. So we've entered this new phase. All the hyperscalers, the AI build out firms, et cetera, they went through that process of sucking capital out of credit markets, or even say SpaceX with that massive IPO, which I don't have the chart here. It's down 50% since its IPO. So you've already got 50% retracement in 1 month. They pulled all the dollar capital out of the table, off the table, like literally preparing for this next phase where dollars become tight, resources become tight, and the only way out is to invest. When I say invest here, I don't mean invest like buy stocks on your Robinhood app or trade, day trade cryptos or altcoins, whatever. I mean, like investment is like that
physically building things.
build long-term durable goods, all of that, real stuff. All right, so just one example here too, just to close this one out. In a pre-recorded interview, Jamie Dimon gave the public his guidance on everything going on and what this means for the short term for the American public. He's just a guy, right? But he sits in a very high up seat. He can see the system, everything going on with much more clarity and deeper horizon than most everybody else. But he said specifically he would not buy long-term bonds or the S&P 500 at current prices. So this is how kind of he's advising or steering the general public in an interview to be aired. I think it was on 60 Minutes. Maybe it'll be on the air this Sunday, but the specs are already or the general talking points are already floating around on central media. So that's what we see here in sovereign debt markets. We've entered a new era. The punch was telegraphed, and it showed up, within a couple of months. So rather quickly, but this was predicted.